The global financial landscape is witnessing significant changes, driven by evolving macroeconomic trends and policy decisions. One of the key shifts is the rise in the volatility in U.S. interest rates, influenced by factors such as a rising fiscal deficit, persistent inflation, and uncertainty surrounding Trump's policies. Another major economy, Japan, seems to be also on the path for higher rates after a period of ultra-loose monetary policy for more than 15 years. Another major change is the move towards deglobalization, as evident from the recent imposition of tariffs by U.S., aimed at protecting domestic interests. Possibility of higher for longer rates, along with rising fears of trading wars, have strengthened the dollar index, leading to currency depreciation and FII outflows from emerging markets. Indian Union budget highlighted continuous focus on fiscal prudence. However, this time, by providing the income tax cuts, government has given preference to consumption boost over capital expenditure, a shift from the earlier budgets. Flexible inflation targeting and fiscal prudence enabled the RBI to shift its focus on economic growth amidst receding inflation. These changing norms, including higher yields, deglobalization resulting from tariff wars, and the Indian government's shift in focus from capital expenditure to consumption, underscore the ever-evolving situations that are significantly different from those witnessed by investors over the past 1 to 2 decades, highlighting the need for adaptive strategies in navigating financial markets. Amidst these uncertainties, Indian equity markets have seen sharp corrections due to continuous FII outflow, rising US yield, and weak earnings growth. Individual stock correction is more severe than what the index suggests. Nifty mid-cap and small-cap forward PE, despite corrections, remains significantly above its long-term average, suggesting overvaluation. Hence, a staggered approach is recommended. Temperature gauge index remains in the fair value zone. Equity markets continue to remain in the consolidation phase amid eventful month and bout of volatility caused by them. While some of the events like Union Budget of India, RBI policy action and Q3 earnings have been well absorbed by the markets, uncertainty around actions by Trump on both trade and fiscal front, China measures to revive the economy, rate hikes by BOJ and INR depreciation still persist. Hence, we expect the markets to remain in this phase for the next 3 to 4 months till most of these events unfold and are factored in by the markets. Such phase of the market should be considered for gradual accumulation. From longer-term perspective, India continues to remain stable and growing economy. Actions taken by the government and RBI are also likely to revive the economy from the rough patch it is going through currently. Earning growth is also likely to be robust for next 2 years. Therefore, based on their risk profile, investors having the appropriate level of equity allocation can continue to remain invested. Considering the ongoing corrections, if equity allocation is lower than desired levels, investors can increase allocation by implementing a lump sum investment strategy for hybrid and large cap equity-oriented fund and staggered approach over the next 6 months for flexi, mid, and small cap strategies with accelerated deployment in the event of a meaningful correction. Since October 2023 onwards, yield curve has shifted downwards on back of favorable demand-supply dynamics, well-contained inflation, and stable domestic macros. With the evolving interest rate scenario, we believe the duration play is in its last leg and long-term yields to remain higher for longer, and hence duration can be exited fully. Actions by RBI on rate cuts and liquidity are likely to result into steepening in yield curve. We recommend fixed income portfolio to be overweight on accrual strategies. Accrual can be played across the credit spectrum by allocating 45% to 55% of the portfolio to performing credit and private credit strategies. In VEETs and select NCDs, 30% to 35% may be invested in performing credit strategies, NCDs, and in VEETs. 20% to 25% may be invested in private credit including real estate, infrastructure strategies, and select NCDs. 25% to 35% of the portfolio may be invested in arbitrage funds, minimum 3 months holding period, floating rate funds, 9 to 12 months holding period, absolute return long for short strategies, minimum 12 to 15 months holding period. For tax-efficient fixed income alternative solutions, 20% to 25% of the portfolio may be allocated in conservative equity savings funds, minimum 3 years holding period. From 2022 onwards, the correlation between US 10-year real rate and gold prices seems to have broken due to increasing uncertainty and world moving away from US treasuries and towards gold. Investment in gold should be done from the asset allocation point of view.